Hi, I will share with you a very simple trading strategy. It is as simple and easy as ABCD. So do hang on because this strategy will show you how to ride strong, massive trend without you pulling out in fear or being scared of losing your profit. You are able to ride the trend as it goes. You're making more profit and you can even comfortably add to your positions without being afraid. This strategy is going to show you how to know when a pullback has ended and you can enter the trade, as well as it will show you where to place your stop loss. It will show you how to determine weak and strong trend so that you know when to stay away from the market. Now, before I start, I will introduce myself. I am Machiavelli Trader. I make videos like this all the time, and if you subscribe, you're going to be the first to get notifications once I upload them on YouTube as well as every other channel. If you've not given me a thumbs up, trust me, if I see your thumbs up, I will smile. It will put a smile on my face and make me to jump on and make a new video because I know somebody is finding it appreciative. Thank you in advance for your likes. Let's jump right straight into it. So before I start, I'll first of all explain the rules that you need to actually follow in order to get this 65% I am promising you increase in your profit rate. Now, this strategy is called the exponential moving average strategy. I'm sure this is not new to you because you must have heard about the moving average, and the moving average and the exponential moving average work hand, they work alike. They do the same thing, but the difference is the exponential moving average gives more power and precedence to recent price, unlike the moving average, which just rate the whole price, the whole time frame at the same time, not giving any precedence to anything. So exponential moving average helps you stay ahead, right? It helps you stay in the forefront of things, even though they are both lagging indicator. So let's jump right straight to it. Now, the first thing is I want to share with you the major rules. There are rules that will help you. The first one is take with trend entries. So after you found the direction of the trend, you want to focus in on trading the direction of that trend because it is likely that that is the least resistant direction. That is the direction that is likely to make more money, right? You don't want to be on the losing side. Now, the second rule is you will see the EMA as guide, right? The EMA serves as support and resistance, but most importantly, they will serve as a guide. Why? Because sometimes you know that this support and resistance get broken, and the exponential moving average, it is not different. Sometimes at some point, the exponential moving average will either be pierced or be slaughtered. Like it will break through it, price will dive straight through it. So always have that in the back of your mind to watch out for the reaction of price once it gets to the moving average. The third law is enter position only when price is on or buy or sitting on the exponential moving average. This is the most important one. Only take entry positions when price is sitting or close by the exponential moving average. Very important, sitting on the exponential moving average without piercing through it. Even if it pierces through it, make sure that the body of the candle doesn't slide through the exponential moving average. That is the most important thing. An additional rule is never place your stop loss directly on the exponential moving average. Now that we know the rules, let's jump right straight into it. So the first question when you come into a chart, the chart will be looking like this. But first, I'm going to turn off the price action, leaving us with just the indicator, right? Leaving us with just the indicator. So I'm going to explain how I use this indicator one after the other. So if you look here, we have three types of exponential moving average here. The first one is called the 20 exponential moving average, right? So what this does is it calculates the first 20 bars and give me the average of them. Now what this also does is I use it for lower time frame. That's the short term trading. I'm talking about if you're a scalper, if you're a day trader, this is your best um strategy, right? This is your best indicator. Some use the 5 EMA and the 20 EMA depending on their scalping, right? Those who trade 1 minute. But if you're trading 15 minutes, 5 minutes, I recommend the 20 exponential moving average is your best catch, right? So in terms, if you are now trading mid-term time frame, let's say from daily chart, like that's 12 hours chart, 6 hours chart, 4 hours, 2 hours down to 1 hour, then I recommend your guide, your good and best friend will be the 55 exponential moving average or the 50 exponential moving average. But in my case, I prefer using the 55 exponential moving average that give precedence to the last 55 bars. Now the third and the most good used for long term. Now, if you're looking to trade in a long term, I'm talking about taking trade that will last you for a week. Maybe you're a very busy person, you keeping your day job and as well as trying to trade. You want to use the higher time frame EMA. I'm talking about the 200 exponential moving average, which is our blue one right here, right? So one thing you will notice is that the 200 exponential moving average is always the last in line. It's always coming behind everything. So first, the 20 exponential moving average is always ahead, followed by the 55 exponential moving average, followed by the 200 exponential moving average. Now that we know what time frame these exponential moving averages can be traded, now let's talk about how to use it to find a trend. Now, if you look at this exponential moving average here, first we'll talk about the downtrend, right? So we see that price is moving downward, is sloping downward. Now, one thing I want you to pay attention to this price sloping downward is the fact that the 20 exponential moving average is below the 55 exponential moving average, while the 55 exponential moving average is below the 200 exponential moving average, pointing downward. And the three exponential moving average are stepping downward, showing you downtrend. So if I turn on my price, you see price is respecting the 20 exponential moving average, right? So if I zoom in now, you're going to see what I'm talking about. You see price respecting the 20 exponential moving average. So you see price is respecting the 20 exponential moving average. At worst, right? Because it's a midterm and this is a daily chart, you see that in daily chart, which also makes use of the mid-time indicator, which is the 55 exponential moving average, you see that price always halts when it comes to the 55 exponential moving average without even being able to make it close to the 200 exponential moving average. So that's to show you that price is on the downtrend. Now, the next type of trend that this exponential moving average can help you find is called the sideways movement or the flat trend or the consolidation, whatever you want to use to call it. Now, this trend shows you price is not moving anywhere, but instantly price is in a standstill, just moving sideways. Now, what happened in such situation? How will you know using this exponential moving average? When there is sideways movement, you see that the exponential moving average starts to slip and move up and down each other. They don't have clear direction of where they are going because even price itself does not have clear direction. So you see price and the 20 exponential moving average and the 50 exponential moving average moving back and forth the 200 exponential moving average, showing signs of accumulation. Now, this is also how you're going to know when a trend is reversing. In terms of trend reversal, you see that trend was going downward, which showed a downtrend, but we are hoping to find when trend is going to reverse from downward to upward. So we know that when we see accumulation going on, it means that this accumulation is likely going to either break to the upside or the downside, because it means there's a lot of pressure accumulating in this zone, and at some point there will be an escape route, right? So what we are trying to find out is to time when this escape route is going to happen and to take our trade in the direction that the trend will continue from. So in this situation, when we see this sideways move by this indicator, we know that it is time to stay away from the market, and probably this is a long-term chart, so we stay away from the market, we wait for breakout. So in this situation, we're going to look for our golden cross, something called the golden cross over, and that golden cross is referred to as when the 20 exponential moving average and the 55 exponential moving average is finally crossing over to the top from the bottom. Remember, here it was all below it, it's still below it here, but it needs to cross over and start moving above the 200 exponential moving average. But that is exactly what we saw here when we see price crossing over the 200 exponential moving average. But you will tell me, hey Machiavelli, can't you see that price also tried to cross over here as well as here? Because you see the crossover, but instantly fall, and again it instantly fall down. How will I know when the crossover is not fake, right? So that I won't fall for fake breakout. Well, here is your answer. In times of breakout, right, in terms of crossover, you want to, let me turn off the price candlestick so that you see clearly. If you look closely, you see that the first attempt to cross over failed, and it showed a clear curvature, right? You see this clear curvature. You see also the attempt to cross over failed again with a clear curvature. The same thing happened. There's a curve happening here, but in the situation of this crossover, it is clear that it is pointing up, right? You see this clear crossover happening where price is now pointing to the upside without looking back, telling you that right now price is being guided to the upside. Now that is the one part. The second part to know when price is now on the upside is when price is now being guided out above the above the 200 exponential moving average by the 20 and the 55 exponential moving average. So if you look closely, you see that here, though price was being guided by the 20 exponential moving average, price broke through it here and come below it, right? So that's a failure, right? That's an instant failure. It tried again and it broke below it. That's another instant failure, which means you can't take that trade. Here again, if you come, you see it price was being guided until it moved above the 200 exponential moving average. But instead of continuing the journey, the 55 exponential moving average didn't make it far, as well as here. You can see, even though the 20 exponential moving average crossed the 200, the 55 exponential moving average did not make it above here, right? You see it, the 55 did not make it above. So the first one was a wrong crossover, right? We didn't take that trade. We're waiting for the 55 exponential moving average to prove that this cross is real. But once it did, there was no strong volume to support the crossover. Now, the most important thing is when you are seeing a crossover of this trend, of this exponential moving average, you want to see volume accompanying this crossover to show you that yes, liquidity is likely to have a follow through buy. You understand? So what happened? This is also a fail. No volume to prove that this is going to hold up. But in the situation of here, you can see the first attempt also failed, right? There was a failure. There was no much volume. But what happens when it happened here? You can see that the volume, the bars of the volume is beginning to increase. So this gives us our confirmation, and as well as the pointing of the exponential moving average, showing that price is beginning to reverse. So this is our trend reversal point. Now, if I want to catch this entry, let's say I want to catch this entry, but here is too high. Where will I place my stop loss, right? Because if I put it, this is high. Why didn't I enter trade just here, right? I could have entered trade here, not here, because if I'm waiting for this crossover to take place, I will likely be entering the trade late, right? So this cross happened here. I could have taken my entry here, right? So why didn't I? No, the cross happened here, right? The bigger cross happened here, right? I could have taken the entry here. Now, to do this, you want to go over to the, let's say you're trading the daily chart. You want to go to at least the 4 hours or the 1 hour chart. So if I go to the 1 hour chart, it changes everything, right? So I want to catch that sniper entry, right? So this is where it happened. So if I scroll the way back, you see that our entry is right here, right? So 1 hour chart is a bit noisier than the daily chart. The lower the time frame, the lower the time frame, the more noisy it gets. So you can see that our entry on the daily chart would have been somewhere around here. But if we take 1 hour chart, we see that the cross happened earlier, right? So when we zoom into 1 hour chart, you see that price successfully crossed over in this zone, right? So from this point, we would have taken our entry, right? At this point, right? But even though it crossed over, there was still sideways movement. There was no clear upward stiff move, but that is okay. Do you know why I said that is okay? Remember that I said that in our lower time frame we'll be using the 20 and the 55 exponential moving average, meaning that our precedence will not be on the 200 exponential moving average. So what we are looking for is the cross of the 20 exponential moving average above the 55 exponential moving average, which happened here, right? So you see all the way here, price is still below the 55 exponential moving average. Price was respecting. Now you can see the respect, how price was respecting the 200 the 20 exponential moving average, right? In the 1 hour. Now see where the crossover took place, and you can see how clear the crossover was. So when I see this crossover, you find out that your entry becomes clear, right? So this becomes your entry point, right? Giving you a sniper entry, and your stop loss is likely going to be here, right? That is where your stop loss is going to be. Now, the good thing about this entry is also the fact that when you are trading entries, you want to allow this pullback before you enter, right? Like I said, let's say you missed the entry here, right? You didn't take this entry here, right? And you allow price to move up, right? What you will do is price is now far from the exponential moving average. You allow it to pull back, giving you another chance of entry here, right? And the good thing is the market structure remained bullish. What do I mean? You still keep having higher lows as it goes. It's still forming higher lows, right? So you see the market structure remain bullish as price kept moving. So even if we go back to our daily chart, we cut that entry right on time, giving us a sniper entry. So if we enter trade at that particular entry, we are likely going to be riding it all the way up, right? So how do I know when to exit a trend? When this crosses over, you will stay in the trade as long as this 20 exponential moving average keep diverging from the 55 and the 200 exponential moving average. As price is leading it away, you keep staying in the trend until it gets to a point where price curves down and crosses below the 20 exponential moving average. You can see when price broke below the exponential moving average, it is being caught by the 200 exponential moving average. And the 200 exponential moving average also stayed bullish by pointing upward, telling us that we are still in a bullish trend as long as it is still pointing to the upside without going sideways or pointing downward. So that is why you are likely going to still stay in this trade, because it is being caught by the 20 exponential moving average. Let's say you miss the entry here and you want to join the with trend entry. Remember, I said this video will show you how to join any strong trend. So we have a strong trend here. So what you're going to likely wait for the pullback. And as long as I turn off the candlestick chart, you're going to see that the 55 and the 20 exponential moving average never went below the 200 exponential moving average, proving the fact that the trend is still bullish. So as long as they are above the 200 exponential moving average, means that you should still focus on the buying aspect. Now you're going to likely wait for 3 touches on any support, right? So we have our trend line support right here, as well as the 200 exponential moving average. We're waiting for 3 times touch. On the third touch, you want to enter the trade. So the first touch was here, right? So this is our first touch, this is the second touch, and this is our third touch, right? So the reason why you want to wait for 2 touches, complete 2 touches, and enter on the third touch is the first time price is going to come and hit the low. The second time, price is going to come back to find if it's going to find buyers on the support, right? So if you find buyers, it's going to get pulled up. Now, when it pulls up, it's going to come back to retest the low of that last low. thereby forming higher lows, and then price picks up. So this is your entry, and your stop loss is going to be right below the trend line and below the exponential moving average. Please never put your stop loss on the exponential moving average, because likely it's going to get stop hunt. So those who entered in this